Welcome to the Week 4 Live Chat, Part 1. Banking isn't all skyscrapers and corner offices. At its core, it's a business of risk. Capital, credit, liquidity, interest rates, the stuff that can quietly build or suddenly break a bank. Think of it this way. Capital and liquidity are similar to the safety gear on a job site. Most days you barely notice it, but the minute something goes wrong, you find out just how much you depend on these things. Banks are no different. Their cushions of capital, their ratios, their rules, these are all what keeps them upright when the markets stumble. In this session, we're going to strip away the jargon and look at the guts of how banks protect themselves. We'll see why regulators, investors, and bankers spend so much time measuring risks, setting ratios, and keeping score. By the end, you'll see that these aren't just abstract concepts. They're the difference between a healthy bank and one that ends up on the wrong side of the headlines. Capital risk. Think of capital as the safety cushion for a bank. It's the money put in by owners and shareholders that stands between normal operations and outright failure. If losses pile up, this cushion is what keeps the lights on. Without enough capital, even a small shock can tip a bank over the edge. That's why regulators and investors obsess over it. Capital adequacy ratios. Ratios like the capital adequacy ratio, common equity tier 1, and the leverage ratio serve as a bank's report card. They show how much capital is stacked up against risk-weighted assets. The stronger the ratios, the more confidence depositors and regulators have that the bank can weather trouble. These aren't just accounting exercises. They decide whether a bank can expand, pay dividends, or even survive an economic downturn. Basel Agreement. After a series of crises, global regulators got together and basically said enough is enough. That's the birth of the Basel Committee in 1974. Basel I set the first common rules. Basel II tried to refine those rules. Basel III plugged the holes revealed by the 2008 financial crisis. Basel IV continues to tighten definitions and reduce loopholes. Each step makes sure banks across countries play by the same rules because risk has no borders. Liquidity risk threshold. Banks need to prove that they can survive a 30-day cash crunch by holding enough high-quality liquid assets. If the outflows outpace the inflows, trouble begins to show up quickly. The liquidity coverage ratio sets a hard line. The bank needs to have at least 100%. Anything less, and regulators begin asking difficult questions. Sources of liquidity. Most of a bank's liquidity comes from deposits, checking, savings, CDs. But when that's not enough, there are backup sources. Borrowing from other banks in the Fed funds market, striking repo deals, tapping the discount window, or raising money through negotiable CDs and commercial paper. These aren't just accounting entries. They're lifelines when the tide suddenly goes out. The liquidity coverage ratio is one of those guardrails regulators put in place after the financial crisis. It asks a simple question. If the bank were to face 30 days of stress, such as customers pulling deposits, markets tightening, and so forth, would the bank have enough high-quality liquid assets to cover the outflows? The formula boils down to this. Put cash and cash-like assets on top and expected net cash outflows on the bottom. The higher the ratio, the healthier the bank is, at least in the short term. Regulators want to see at least 100% here. In plain English, this is a short-term survival score. A bank that can't meet this standard may be profitable on paper, but in practice, it's one bad week away from collapse. That's why the liquidity coverage ratio is important. It proves the bank has enough financial fuel to keep going, even when everyone else is tapping on the brakes. Net Stable Funding Ratio, or NSFR. If the liquidity coverage ratio is about surviving the sprint, the NSFR is about running the marathon. It looks beyond 30 days and asks this question. Are the bank's funding sources stable enough to support its assets over the long term? The formula compares available stable funding, things like customer deposits and long-term debt, against the required funding need for the bank's asset mix. Over 100% means the bank is in good shape. Under 100% means they are skating on thin ice. The NSFR forces banks to think about timing. Short-term borrowing may be cheap, but if it runs off when the markets get rough, the bank will be left high and dry. Stable funding, sticky deposits, long-term commitments, and such, makes sure the bank can stay on its feet when conditions change. Interest rate risk is the bread and butter of banking. When rates change, loan income and deposit costs move in different directions. Banks cannot control the Fed, but they can control how exposed they are. If they mismanage this, the profits could disappear overnight. Dollar gap analysis. Gap analysis is like weighing a boat. You have to count the interest-sensitive assets on one side and the liabilities on the other. If the assets outweigh the liabilities, then the bank is asset sensitive. If liabilities dominate, the bank then is liability sensitive. Get this balance wrong, and a rate hike or a cut can sink the bank's margins. Interpreting the yield curve. We can think of the yield curve as the economy's mood ring. A normal upward slope means optimism, growth, and positive net interest margins for banks. An inverted curve signals recession fears. In this case, short-term funding costs more than long-term trending returns, which squeezes profits. Flat curves? They just make planning even more difficult. For banks, this curve isn't theory, it's the reality that shapes loan pricing and deposit costs. Chapter 13, Introduction to Credit Risk. In Chapter 13, we shift to the other side of the ledger, credit risk. This is the risk of people not paying back what they owe after borrowing. Loans are the biggest piece of a bank's balance sheet, so when borrowers default, the pain becomes immediate. Different products, industries, and geographies all bring their own twists to this particular level of risk. Risk measurement. Credit risk gets measured through asset quality. We look at total loan losses compared to total loans. The lower that number, the healthier the loan book. If it starts to climb, regulators and shareholders alike both get nervous. Risk mitigation and management. Although banks cannot eliminate credit risk, they can manage it. They do this through loan policies, underwriting standards, structured deals, often requiring collateral, and monitoring their borrowers. It's not about saying yes or no to loans. It's more about saying yes, but under these conditions. Creditworthiness and the 6 C's of credit. When bankers size up a borrower, they run through the 6 C's. These are character, capacity, cash or capital, collateral, conditions, and control. These are not simply numbers on a spreadsheet. This particular relationship is all about trust, track record, and whether the borrower can weather financial storms. Financial condition analysis. This is where the numbers matter. Analysts spread financials, review trends, and check ratios like debt service coverage. EBITDA becomes the quick way to judge if cash flow can cover obligations. It's part art, part science, but always about the bottom line. And that is, can this borrower pay us back? Elements of repayment. Repayment is not a one-size-fits-all proposition. There is the term of the loan, the tenor, the amortization schedule, and the repayment source, usually driven by operating cash flow. If the cash isn't there, even the best paperwork won't save the situation. Collateral is the banker's backup plan. If cash flow dries up, the bank wants something tangible to claim: homes, cars, equipment, or receivables. Collateral doesn't eliminate risk, but it gives banks leverage and an extra layer of protection. The FICO system. Finally, consumer credit boils down to a 3-digit number. Brought to us by the Fair Isaac Corporation, the FICO score ranges from 300 to 850, and it's a snapshot of how risky a borrower is. Behind that score are credit bureau reports, payment history, and patterns of borrowing. For banks, it's the shortcut to answering the big question: what's the chance this customer pays us back and pays us on time? That's a wrap for part 1 of the Week 4 live chat. We've made a sweep of capital adequacy, liquidity, interest rate risk, and credit risk. all critical pieces of what makes a bank either safe or shaky. You're now better prepared to not only weather the final exam, but you're also better prepared to understand the tools that bankers use every day to keep institutions alive and thriving.